All right, so what the heck is index universal life insurance? Well, first of all, you'll also hear it referred to as an IUL for short. But to me, an IUL is just magic and outperforms your 401k in so many ways, and I'll show you how. Make sure to watch to the very end because you'll get an invitation to my free masterclass what the US government and Wall Street don't want you to know about saving for retirement. It's a real eye-opener. Please subscribe and hit the bell to be notified every time I upload a new video. What you'll discover from this video is that an IUL will give you tax-free growth on your retirement savings, tax-free income in retirement, protection from stock market crashes, market-like returns, easy penalty-free access to your retirement savings, and the ability to act as your own financing company for major purchases and investments. Before I start addressing what Index Universal Life Insurance is, it's important you understand what indexing is since this is an indexed product. I'll be comparing the market strategy and the indexing strategy. So just to keep things simple, the market strategy is an investment strategy where your money is in the stock market. So either you have your money with an investment advisor or you have an IRA, 401k, or 403b. With indexing, you choose an index like the S&P 500. Your money is not invested in the index, but you get the return based on the movement of the index. Your money grows however the index performs, up to a limit or a cap, for example, 12%. Now, if the market grows 15%, your money will only grow up to the 12% cap. But the trade-off is complete downside protection from market losses. So just like you would have a cap, you would also have a floor of 0. So the worst thing that could happen is you get 0 interest in market downturns. In other words, you lose nothing, ever. Indexing gives you the ability to grow your money at a decent rate, historically 7 to 8% annually, and be protected from market downturns. There are no contribution limits, no age restrictions, and you have penalty-free access to your money. There are also minimal fees as long as it's structured properly. Now take a look at this chart, which shows you the difference in investing in the stock market via your 401k, IRA, or 403b versus the indexing model. The red line is the S&P 500, and you can see how volatile it was between 1998 and 2013. The blue line is the floor, or the guaranteed return of the indexing product, and the green line is the indexing strategy. So you can see where I've circled in blue on the green line that when the market goes down, you get 0 growth because of the floor. We like to say 0 is your hero. You lose nothing. You can also see that if you had your retirement savings in an indexed product, you would have lost nothing in the last recessions, and you would have been ahead versus any 401k, IRA, or 403b. This is a comparison of the market strategy and the indexing strategy. At a 12.5% cap with a $100,000 balance over the last 20 years, if you would have just gone to sleep and put your money into an S&P 500 index, you'd have $153,000 more in your account with a cap and a floor than you would just writing it out. Before we move forward, I want you to understand ways to fund an IUL. And that is the difference between qualified and non-qualified money. Qualified money is money from a tax-deferred account, like your IRA, 401k, and 403b, and non-qualified money is money you've already paid taxes on, so like a Roth IRA, for example. So going forward, I will refer to these monies as qualified or non-qualified. The IUL was first offered in 1997 by Transamerica, and it has seen tremendous growth over the last 20 years. IULs offer permanent life insurance protection with the opportunity to earn market-like returns inside the policy and living benefits, which I'll explain in a bit. It's really important to understand where this product came from. It's a new take on a very old, stable product from insurance companies that have been in business for over 100 years. They created innovations that made this a lot more profitable for their policyholders. There are 3 vehicles available to get a tax-free income in retirement: a Roth IRA, municipal bonds, and permanent life insurance. In this case, in the form of fixed or indexed universal life insurance contracts. The difference between the 3 is risk, contribution limits, age restrictions, returns, how your money grows, income, required minimum distributions, or RMDs, fees, funding, access to your money, death benefits, and living benefits. An IUL contract has no risk to stock market downturns because it's an index product with a ceiling and a floor, so 0 risk. No annual contribution limits, no age restrictions, easy and penalty-free access to your money, market-like returns, your money grows tax-free, you get a tax-free retirement income, no required minimum distributions, you get a death benefit and living benefits, and limited fees only if it is structured properly. And by saying that, you really have to be careful about this because there are not many agents who know how to structure these properly. Now, unlike an annuity, you cannot roll over a 401k or any other qualified money into this account unless you pay the taxes on your qualified funds first. So what is your plan for long-term care? What happens if you have a heart attack, a stroke, or become disabled? Everything you plan for retirement could be wiped out if you don't discuss this. So enter the living benefits of life insurance. Because this is a life insurance policy, you have access to the death benefit tax-free while you're alive in the event you have a critical or terminal illness or you're diagnosed as chronically ill and unable to perform 2 of the 6 activities of daily living, such as bathing, dressing, eating, toileting, transferring, or due to cognitive impairment. It allows the death benefit to be distributed before death to pay for qualifying medical costs and long-term care. These are generally known as accelerated death benefits. Your policy will pay a discounted portion of the death benefit in a lump sum, tax-free, if the insured becomes chronically ill and symptoms persist for more than 90 days. Critical illness covers you if you're diagnosed with a serious but recoverable condition. And terminal illness is an illness or condition that is expected to result in death within 24 months. You can receive a portion of the death benefit while you were living to pay for long-term care expenses. But you must have the impairment for 90 days, which is known as the elimination period. Once the impairment has been certified, the insurance provider will begin to reimburse long-term care costs. Now, the IUL I'm going to introduce to you is all about growing your wealth and not about the death benefit. We flipped that on its head and designed a product where you can put as much money into it to grow your wealth, but with the smallest death benefit the IRS will allow. Like I said, very few agents know how to structure these properly for maximum cash growth, or possibly they do and are commission hungry and will sacrifice your money's growth only to put more money in their pocket. I will keep saying it. Beware of bad agents. They are everywhere. So you would commit to a monthly or annual premium. And if you want to supercharge your policy, you can contribute a lump sum up front, IULs require between 12 to 15 years to hold a reasonable cash value. You may be asked to complete a health examination as part of the application process with the IUL. One of the most powerful concepts behind an IUL is the ability to access your cash by taking participating loans from your cash value to finance a car, a vacation, or real estate, or really whatever you wish. Because you're actually borrowing from the insurance company, they're using your cash value as collateral. So even though you take out a loan, that money is still in your account and keeps earning interest. Let's say you have $100,000 in cash value in your policy, and you decide to take out a $20,000 policy loan to buy a new car. Let's say the insurance company charges you 5% on the loan, and the market went up 10%. That loan didn't cost you anything. You actually made 5% on the money you loaned yourself. One of the greatest differences between policy loans and traditional loans is that you don't have to pay back the loan to your insurance policy. When you borrow based on your life insurance policy's cash value, you are borrowing money from the life insurance company. A loan from your insurance company is a lot easier, of course, to get than a bank loan because it uses the cash value of your policy and the death benefit as collateral. If you don't pay back the loan, they'll take it from your cash value or your policy or deduct it when the death benefit is paid out. If you do not pay the loan back and the interest combined with the amount borrowed starts to exceed that cash value, you could put your life insurance policy at risk. So let's compare income from your 401k versus an IUL. Take a 65-year-old whose annual income was $97,000 while he was working, and he wants to maintain that same income in retirement. With a 401k, he has $858,000 in retirement savings. He withdraws $129,340, knowing he'll have to pay $32,335 in taxes on that withdrawal in order to get to his $97,000 income. This poor guy will run out of money in 9 years at the age of 74. The 65-year-old with the IUL has $709,000 in retirement savings. He takes his $97,000 annual income tax-free and has an $864,000 life insurance death benefit. If he dies at age 100, he would have received $3,395,000, and his family receives $3,036,000 in death benefit, both free of income tax. More than 3,000 big banks and 85% of Fortune 500 companies buy cash value life insurance by the hundreds of billions in assets as part of their Tier 1 capital, which is the safest money they have. But it also has to be liquid, give them solid growth, and they're not going to lose it in a market downturn. JCPenney used cash value life insurance during the Depression to keep his company afloat. Ray Kroc used it during the expansion years at McDonald's to cover payroll when sales were low and his franchisee fees weren't covering it. And Walt Disney used it to purchase the land that Disneyland is on today. This is a proven strategy that has only gotten better over the years, and the fees and the costs are so much lower than they used to be. So you don't have to be a millionaire anymore to use it. And Ted Benna, who is the founder of the 401k, he watched Wall Street and big business just really pervert the 401k in ways he could never possibly predict. He's been saying for years that his creation has turned into a monster that should be blown up. He said these plans have grown so overcomplicated and are so fraught with hidden fees and opportunities for bad decisions that they were better at enhancing the financial industry than the actual savers. And these types of abuses in the financial industry are why he created the 401k in the first place. So, where does Ted Benna put his money now? Cash value life insurance. I think the most exciting benefit of this strategy is taxes, because this properly structured IUL takes advantage of IRS code 7702, which allows your retirement income to be tax-free. Your money grows tax-free. You pay 0 taxes on your IUL retirement income, no taxes on your estate and inheritance when you die, and your beneficiary pays no taxes when they claim the life insurance death benefit. Like I said, very few agents are trained on how to structure these innovative policies to optimize the growth of your money. Just be so careful. Now, why do I think taxes and IULs are so exciting? Well, former Comptroller General David Miller said in 2009 that future taxes would have to double or our country will go bankrupt. Even before the onset of COVID-19, the Congressional Budget Office warned that marginal tax rates would need to more than double in the next several years just to keep up with Social Security, which is projected to become insolvent in 2035. Medicare, which will run out of money in 2026, and Medicaid in 2028. And the Congressional Budget Office reports if Social Security, Medicare, and Medicaid go unchanged, the lowest tax bracket would increase 2.5 times. And people don't want these benefits to go away. And of course, like I said, this is all before COVID-19 and its effects on the economy. Now, we're going to get into the guts of the proper way to structure an IUL for maximum cash accumulation. There are 2 ways you can structure these. The traditional way, which has a really bad reputation because of high fees, high costs, and high commissions. Traditionally, they were sold as a very expensive insurance policy that made agents big commissions. So as you can see, the bulk of your money here goes to insurance costs, and your cash value is minimized. The death benefit is what drives the fees, commissions, and the cost of the policy higher. There are some stark differences between the traditional way and what can actually be done if you know what you're doing. You flip this concept upside down. You maximize the cash value in your IUL, and you minimize the insurance cost. Structured this way, it reduces the administrative costs for your insurance because your death benefit is lower, so the commissions paid to an insurance agent are lower. So when you hear Dave Ramsey, Susie Orman, your financial advisor or CPA or brother-in-law saying these policies are expensive and not a good investment, they're talking about the red bucket over there. So let me give you a hypothetical situation of a 45-year-old man putting in $20,000 a year. I'm going to pull back the curtain and show you how the same amount of money going in can have a dramatic difference in your retirement cash flow and the commission your insurance agent would make. If you were to use a typical structure like the red bucket with a level death benefit and no cash optimization, and this 45-year-old man is putting in $20,000 per year for 21 years, at age 65, he's going to have $523,000 of cash value, a $1.5 million death benefit throughout the life of the contract, and the agent who sells that is going to make a $27,000 commission. So the guy's putting in 20, and the agent's making 27. That's a pretty good sized commission, right? So this is the way these policies were traditionally structured. Very few agents know how to structure an IUL for maximum cash accumulation. You can use cash maximization and still use a level death benefit, and it improves your cash value significantly. Now get this. You lowered your death benefit by $500,000, and look what that did to your cash value. It increased it by $141,532. Did you put any more money into this? Same amount of money, different structure. And look at what the agent gave up in order to give you $141,000. That's about $8,000. So doing it this way, it cost the agent $8, but made you $141. Do you think it's right for an agent to cost you $141,000 in order to put another $8,000 in his own pocket? No, and I don't either. It's borderline criminal as far as I'm concerned, and that's why I don't build these policies this way. Now, there's one more thing you can do if you know what you're doing, and that is to use an increasing death benefit. And this is where it gets extremely efficient. You start with the lowest death benefit the IRS will allow, and you step it up each year as your cash value grows. This drops the death benefit another $644,000. So from the first to the third, we dropped $1.1 million off the death benefit, and look what it has done to the agent's commission. It's cut the commission $20,000 overall. Let's see what it does to your cash value. So you've gone from $523,000 to $811,000. That's almost $300,000. And again, did you put any more money into this policy? What's the only difference? Well, it's using somebody who structured it right and knows what they're doing. So to wrap it up, the benefits are undeniable. It is best for people who are 15 to 20 years from retirement. Your money grows tax-free, and it is distributed to you in retirement tax-free. There is zero risk to stock market downturns. There's no age or contribution limits. You have penalty-free access to your money through participating loans, where you can finance your own big-ticket items. You get market-like returns and have a death benefit with living benefits in case you were to have a heart attack, stroke, or, God forbid, something happened to you. But most importantly, an IUL needs to be structured properly, or it will be an expensive life insurance policy with the agent laughing all the way to the bank. If you're interested in learning more about a very special 5-year IUL, where a lender will actually match your annual contribution 3-to-1, you got to take my masterclass. What the U.S. government and Wall Street don't want you to know about saving for retirement. A life insurance policy is jointly funded by the participant and the bank financing. The bank financing provides approximately 60 to 75% of the total premiums to the policy. And then that you can realize benefits far beyond what your annual contributions alone would afford them. Once you've completed the masterclass, and I'll put that link below, you will be invited to apply for a free retirement income analysis, where you will learn exactly how much income your current investment accounts will produce and for how long. This is invaluable information. If you don't know these numbers, you are literally gambling on your retirement. If this video has been of value to you, please give it a like, make sure to subscribe, and hit the bell to be notified every single time I upload a new video. Also, comment below with your biggest takeaway, and also feel free to let me know what other topics you'd like for me to cover.